Have you ever planned, the perfect summer outing, maybe a big barbecue or a trip, only for it to get completely rained out unexpectedly?
Oh, definitely. It's so frustrating when the weather just throws a wrench in everything.
Right. And it's not just us. Today, we're going to see how that same kind of disruption, that unpredictable weather, can hit even massive global businesses.
Exactly. We're diving into Varun Beverages Ltd, VBL. They're one of the biggest PepsiCo franchisees out there. Huge global footprint.
Oh, operating across, what, 10 countries with franchise rights, plus another 4 where they handle distribution, so a major player.
And our mission today is to really unpack their latest numbers, the unaudited financial results for the second quarter and first half of their calendar year 2025.
We've got the official board meeting notes, the financials themselves, their results presentation, the press release, and importantly, insights from their recent earnings call.
So we'll look at how they navigated this, well, unseasonal chill, their strategic moves, what worked, what didn't, and what it signals for their future.
Okay, let's get into it. So VBL runs on a calendar year. Q2, that's April to June, should be their absolute peak. Summer, hot weather, people drinking lots of beverages.
Usually, yes, prime time. But this year, a big challenge landed right in their lap.
Which was?
The weather, basically. It had a direct, measurable impact. For Q2 CY 2025, their consolidated sales volumes actually went down by 3.0%.
Down in peak season.
Yep, dropped to about 390 million cases from over 400 million the year before. And the main reason cited was, and I quote, abnormally high unseasonal rainfall throughout the quarter in India.
Wow, so India really got drenched, and that hit their biggest market hard. The numbers show India volumes fell 7.1%. That's significant.
It really is. But here's where it gets interesting. Despite that volume drop in their core market,
How did the financials hold up? Did revenue just tank?
not as much as you might expect. Net revenue from operations decreased, yes, but only by a modest 2.5%, pulled back from almost 72 billion rupees to just over 70 billion.
Okay, so a dip, but maybe not catastrophic.
But wait, there's more. Net profit after tax, Pat, actually increased
Increased. Profit went up.
by 5.0%, up to over 13.2 billion rupees from around 12.6 billion. And EBITDA, their operational profitability measure,
Yeah.
that nudged up slightly, 0.4% to nearly 20 billion rupees. And crucially, their EBITDA margins improved by 82 basis points, almost a full percent, landing at 28.5%.
Okay, that is a strong counter-narrative. Growing profit when volumes and revenue are down in your main market? How?
It points to some serious operational muscle, right? Efficiency gains, maybe strategic pricing, and definitely help from other areas.
Which we'll get into. But fundamentally, this is about resilience, isn't it? Leveraging scale and strategy to weather a storm, literally.
Exactly. It shows how diversification and tight operations can make a huge difference when unexpected things happen.
All right, let's focus on India first. The rain hit hard, but beyond that, what was happening on the ground? Product mix, pricing, any specific tactics?
Well, the volume drop in India did mean that the overall net realization per case consolidated only improved slightly, just 0.5%.
Okay.
But part of that was a conscious choice. They apparently pushed packaged drinking water more deliberately during this sort of off patch.
Why water? Isn't that lower margin?
It is. Water's more of a commodity, lower realization per case. But they did it strategically to support their distributors, keep product moving through the system. This actually led to the derived average selling price, the ASP, being negative 2% in India.
Ah, so helping the network, even if it meant a temporary hit on the average price per case. What about the types of drinks? Still mostly carbonates?
Yeah, CSDs, carbonated soft drinks, were still the bulk of it, 75% of total volumes in Q2. Packaged water was 18%, and non-carbonated beverages like juices were 7%.
And were people buying the usual sizes? Did the rain change buying patterns?
It seems so. They noted that small packs continued to do well, but the larger packs saw declines, which kind of makes sense, right? Fewer big outdoor gatherings, fewer parties maybe, because of the constant rain.
Makes sense. And are they still pushing to expand their reach, even with these hurdles?
Oh yeah, they're aiming high, currently serving about 4 million outlets, and the goal for this year is to add another 10%, so maybe 300,000 to 400,000 more outlets.
Ambitious.
Very. Although they did acknowledge the rains might affect hitting that exact number, because some temporary rural outlets, which are common in the industry, just might not have opened up this season. An industry-wide thing, apparently.
So dealing with the present, but also planning for the future. What about production capacity? Did the rain impact their ability to produce or maybe highlight needs for the future?
That's a key piece. They've been investing heavily. In the first half of this year, H1CY 2025, they spent around 14,500 million rupees, that's 14.5 billion, setting up 4 brand new greenfield plants in India.
4 new plants. Where?
Prayagraj in UP, Buxar in Bihar, Damtal in Himachal Pradesh, and Mendapethur in Meghalaya. These all started production between March and May this year.
Strategically placed, it sounds like.
Definitely. Aimed at boosting capacity and making the supply chain nimbler in areas they see as high potential, but currently underserved. Plus, they spent another 1.2 billion on expanding an existing plant, a brownfield expansion in Surrey.
So a lot of investment coming online. How's their overall utilization now? Are they running flat out?
Actually, no. They mentioned current capacity utilization is around 70%.
Oh, okay. So they've got quite a bit of headroom then.
Seems like it. Enough for the next couple of years in India, they suggested. Without needing another massive wave of capital spending there, they built ahead of the curve.
So laying the groundwork, building the infrastructure for future demand, even if this specific quarter's weather kind of dampened the immediate returns from those new facilities, smart long-term thinking.
Exactly. Positioned for growth when conditions improve.
Now, while India was challenging, you mentioned the international picture was brighter.
Much brighter. That was really the lifeline this quarter.
Yeah.
International volumes grew by a very healthy 15.1% in Q2.
15%. That's huge. Where was that coming from?
South Africa was a real star performer, up 16.1%. And across their African territories, they also benefited from strong positive currency movements, which helped the numbers look even better.
Nice. And did prices hold up internationally?
They did better than hold up. Net realization per case in the international markets saw a significant jump, 6.6% improvement. So strong volume and better pricing power overseas.
Fantastic. So what are they doing internationally to drive this? Is it just market growth or specific initiatives?
A lot of specific initiatives. It's not just beverages anymore either. In Morocco, their subsidiary just started commercial production of Cheetos.
Cheetos. So they're getting into PepsiCo's snack business too.
Yep, a big move to diversify and tap into that high-potential snack category. In South Africa, they've added a new can line in Durban, and they're waiting on regulatory approval to get more land next to their Boksburg plant for expansion and backward integration.
Backward integration, like making their own supplies.
Potentially, yeah.
Yeah.
Controlling more of the value chain. They're also putting more money into their subsidiaries in Zambia, the DRC, and South Africa, strengthening their balance sheets. They're even upping their stake in Zambia from 90% to 95%.
Busy overseas. Any other snack expansions?
Yes, the Zimbabwe snacks plant is being built right now, expected to start up around October, November this year.
So a really aggressive push, internationally organic growth, diversification into snacks, strengthening existing operations.
And acquisitions, too, don't forget that. They pumped another 4.1 billion rupees into the beverage company in South Africa, taking their stake up to over 97%.
Okay, really consolidating their position there. And wasn't there something about Sri Lanka, too, and coolers?
Ah, yes. Very interesting move. They bought a 50% stake in a Sri Lankan company called Everest Industrial Lanka, or EIL. Cost about $3.75 million US.
And EIL mix?
Visi coolers, those glass-fronted fridges you see drinks in. And related accessories.
Huh. So VBL might start making its own coolers through this joint venture.
That seems to be the idea. It gives them potential control over a really critical piece of their on-ground execution, especially thinking about markets like South and West India, where getting enough coolers into stores is key. A strategic play to own more of the infrastructure they need.
Fascinating. Control the coolers, control the visibility. Okay, so with all this activity, international growth, new plants, acquisitions, let's circle back to the overall financial health. You mentioned profit was up despite the India dip. How strong is their balance sheet?
Extremely strong. They were actually net debt-free at the end of Q2, holding over 5.1 billion rupees in free cash.
Net debt-free for a company expanding like this.
Yeah. And their credit rating is top-notch CRISIL X stable. The huge chunk of money they raised last year through that QIP, the Qualified Institutional Placement.
Right, about 75 billion rupees.
That's been fully used now, which means their finance costs for the Indian business are basically negligible. Any interest costs they still have are mostly linked to international operations, particularly South Africa.
Wow, okay, that explains a lot about how they could absorb shocks and still invest. But what about those efficiency gains? Margins went up. How sustainable is that? Was it just currency effects, or did they actually cut operational costs?
It was a mix, but management emphasized the operational improvements. Remember, EBITDA margins rose almost 1%, even with the fixed costs of those 4 new plants kicking in.
So how'd they do it?
Several things. They got smarter with freight consolidating distributor loads, using the new bigger plants more strategically to cut down travel distance per case. They rationalized manpower, looked at routes and sales structures,
Okay.
and power and fuel efficiency improved too. Newer production lines are just more efficient, plus they're using more renewable energy.
And management thinks these savings will stick.
They stated quite clearly they believe these cost reductions are sustainable. So not just a one-off quarter thing, but real structural improvements.
That's impressive. Okay, any other big news from the board meeting? Corporate stuff.
Yes, a couple of key things. They declared a second interim dividend for 2025, 50 pays per share. That's about 1.7 billion rupees going back to shareholders. Record date is August 2nd, payment from August 5th.
Good news for shareholders. Anything else?
A big appointment. Mr. Pankaj Madan is the new Chief Financial Officer, the CFO, and key managerial personnel. He started July 30th.
Pankaj Madan, does he have relevant experience?
Oh, yes. Chartered accountant, MBA, 35 years under his belt. He was Group CFO at Interglobe Enterprises, think Indigo Airlines, and held CFO roles at Party Walmart before that. So deep experience in large, complex organizations.
Seems like a strong hire. Okay, so solid financials, efficiency gains, shareholder returns, new CFO.
Yeah,
Stepping back again, what about the non-financial side? Sustainability, maybe? Is that on their radar?
very much so. They talk about being water positive, meaning they claim to replenish more water than they use in their operations. And they say water consumption per liter produced is going down.
That's significant for a beverage company.
Absolutely. They're also focused on their carbon footprint, aiming for net zero by 2050. That involves increasing renewable energy use and switching to more eco-friendly Visiga coolers, the ones using R290 refrigerant.
And plastics. That's always a big issue for beverages.
They're tackling that too. Working on a circular economy approach, increasing plastic waste recycling, reducing the amount of plastic in things like bottle preforms and caps. They have a target of using 30% recycled PE, or RPET, in their packaging by 2025.
Are they using RPE already?
Yes, they've mentioned specifically using it for brands like Pepsi Zero Sugar and Sting Energy already. So definite progress on the sustainability front.
Okay, so looking ahead now, they navigated a tricky quarter, they've made strategic moves, efficiency seems strong. What's the feeling from management about the rest of the year?
The chairman, Mr. Ravi Jaipuria, sounded pretty confident. He basically said, look, we've handled challenges like this before and come out stronger. They're doubling down on execution, getting more coolers out there, making sure products are available everywhere.
And they feel the investments they've made position them well.
Yes, with the new capacity online, the broader product portfolio, and interestingly, they noted that low or no sugar drinks made up about 55% of sales volume in the first half.
55%. Wow.
Yeah. So with all that, plus the focused distribution, they feel they're set up to grab opportunities and create long-term value.
But I guess the weather is still a bit of a wild card for the next quarter.
Definitely. They acknowledge the outlook, especially for Q3, really depends on the rain gods, as they put it, but they sounded, quote, quite positively optimistic.
Why optimistic if rain is still a risk?
Because last year's Q3, July to September, apparently wasn't very strong. So the comparison base is more favorable this year. They feel that just a little bit weather break will do extremely well.
A bit of sunshine would go a long way, literally. And what about bigger strategic moves, acquisitions, more expansion?
They were very clear on that. They are, and I quote, very actively looking for new acquisitions and expansion opportunities internationally. They plan to use that strong cash position for growth.
So using the financial strength to fuel more growth. What about India? More big spending there.
Probably not major new plants for the next year or two, since they have that 70% utilization headroom, but they will keep investing and expanding their solar energy generation. Self-supply to save more on energy costs long term.
Smart. Okay, so let's try and wrap this up. To summarize our deep dive, VBL faced a real challenge in Q2 2025. Unseasonal rain hit India hard, impacting volumes in their biggest market.
Yeah, a real curveball. But despite that, they managed to grow their profit. It's pretty remarkable.
And they did it through a combination of things, right? Strong international growth offsetting the India dip.
Definitely. Plus diversification to snacks, really tight cost control, and operational efficiencies, which they say are sustainable.
Proactive balance sheet management, being net debt-free, and making those big forward-looking investments in new plants, sustainability, and even things like Visi-coolers.
Exactly. It really showcases their operational agility and a clear strategy focused on diversified long-term growth, not just surviving quarter-to-quarter bumps.
So maybe the key takeaway for you listening is how VBL managed to turn what could have been a disastrous quarter into, well, a demonstration of resilience and smart strategy.
And as they continue to push into new areas, more countries, snacks, maybe even making their own equipment like coolers, it really poses a question for any large company today. In a world that seems increasingly unpredictable, just how vital is this kind of diversification combined with relentless internal efficiency to guarantee success in the long run?